AMD is up 250% in a year. It's about to cross $1 trillion market cap. The headlines are calling it the next NVIDIA, and every YouTuber is screaming buy. But here's the thing nobody is telling you. At today's price, AMD is expensive and a lot more expensive than NVIDIA. Today we're going to look into AMD as an investment, whether it's still got more room to grow, to go up, and whether if you're putting money into AI chips right now, you're putting it into the right one. Let's get into it, and before we do, subscribe to this channel. I post at least 5 videos per week for long-term investors. Okay, AMD, quick refresher for anyone who wants to know about it. AMD makes computer chips, same kind of business as Intel and NVIDIA, but with a different focus. They make CPUs, the brain chips inside servers and PCs, and they make GPUs, the specialized chips that train AI models. For decades, AMD was a distant second to Intel in CPUs, and a distant second to NVIDIA in GPUs. They were the cheaper option, the underdog, the buy if you can't afford the leader play. Then in 2014, the company hired a new CEO. Her name is Lisa Su. She has a PhD from MIT and a quiet methodical management style that doesn't make headlines, until you look at what she's done. When Lisa Su took over, AMD stock was at $2. Today it's at 467. That's a 233x return in just over 10 years. Think about it like this. If you put 10 grand into AMD when she took over, you'd have over $2 million today. So this is not just any company. This is one of the most successful turnaround stories in the history of business. And in the last 12 months, that story has gotten even bigger. There are 3 things that drove AMD's 250% increase over the last year. 1, the AI build-out finally started flowing into AMD. For years, NVIDIA had basically the entire AI chip market to itself. Every major company building AI was buying NVIDIA chips. AMD was just an afterthought. Then in late 2025, the dam broke. Meta announced they would deploy 6 gigawatts of AMD's Instinct GPUs. To translate that, that's tens of billions of dollars in chip orders. OpenAI committed to another 6 gigawatts. Microsoft, Amazon, and Google all expanded their AMD orders. Suddenly, AMD wasn't an afterthought anymore. It was a real second source for AI compute. Next, AMD's CPU business, which everyone had forgotten about, suddenly started crushing it. And the reason has something to do with agentic AI, the new generation of AI that doesn't just answer questions, but takes actions. Agentic AI needs an enormous amount of CPU power to coordinate between AI models. And AMD's chips are now considered the best on the market for those purposes. In their last quarter, AMD's data center revenue grew 57% year on year, hitting $5.8 billion. CEO Lisa Su told analysts, "This was a clear inflection in our growth trajectory." Lastly, Wall Street finally noticed. The stock more than tripled in the last 12 months. AMD's market cap went from around $200 billion to $762 billion. The company is now closing on $1 trillion market cap, something that was unthinkable 2 years ago. So that's the bull case, and the bull case is real. But now we have to talk about the part that nobody else on YouTube is probably showing you. I'm going to put the 2 companies side by side, so pay attention. AMD, stock price 467, market cap 762 billion, last quarter's revenue 10.3 billion, annual revenue trailing 37 billion, last quarter's net income 1.4 billion. NVIDIA, stock price 215, market cap 5.2 trillion, last quarter's revenue 81.6 billion, last quarter's net income 58.3 billion. Let me translate what that means. NVIDIA's quarterly revenue, 81.6 billion, in just 3 months is more than double AMD's revenue for the entire year. NVIDIA's quarterly profit, 58.3 billion, in 3 months is bigger than AMD's annual revenue. The profit from 1 quarter at NVIDIA is larger than the entire top line of AMD for an entire year. That is the gap. Now let's get to the part that should genuinely surprise you. Stock valuations. The most common way to measure how expensive a stock is, the price to earnings ratio, or P/E, tells you how many years of profits you'd have to add up to equal the stock's price. Lower is cheaper, higher is more expensive. The forward price to earnings ratio of AMD is about 67. NVIDIA is about 25. That's not a small gap. NVIDIA is trading at 2.5 times the valuation. AMD is trading at 2.5 times the valuation of NVIDIA. So in plain English, for every dollar of next year's profits, you're paying $67 if you buy AMD and $25 if you buy NVIDIA. The challenger is more than twice as expensive as the incumbent, the slower growing company, the smaller company, the one with worse profit margins. So how does this happen? The market isn't stupid. When AMD trades at 67 times forward earnings and NVIDIA trades at 25, the market is telling you something specific. It's saying NVIDIA is already great. We know it's great. We've priced it like it's great. The question from NVIDIA here is mostly about defending its lead. And people aren't sure about how much room there is to keep doubling. But AMD, the market is saying, AMD is becoming great. The story is in mid-transformation. The growth rate is higher. The base is smaller. The room to scale is bigger. Wall Street isn't paying for what AMD is. Wall Street is paying for what AMD might become. And that's a perfectly defensible bet. If AMD's data center business keeps growing 57% per year, if the Meta and OpenAI deals deliver as promised, if the next generation chips beat NVIDIA's, if Lisa Su pulls off another miracle, then 67 times forward earnings is actually cheap, because the earnings number itself may well explode. And that's the bull thesis in one paragraph. Now the bear case in one word is perfection. When you pay 67 times forward earnings, you're pricing in flawless execution. AMD has to keep growing data center revenue 50% year on year. Their new chips have to be excellent. The Meta deal has to deliver. The OpenAI deal has to deliver. NVIDIA has to not engage in a price war with them. And quietly in the background, the entire AI CAPEX cycle has to keep growing. The minute any of those assumptions break, the multiple compresses. And then when a multiple compresses from 67 to 35, which would just be normalizing toward the semiconductor sector average, then the stock would fall maybe 50%, even if earnings double. And that's the math of expensive stocks. The growth has to keep being spectacular. Anything less than spectacular in the stock falls hard. And that's not me being bearish on AMD. The business is genuinely spectacular. They have one of the greatest CEOs of this generation. And the product roadmap is real. The question isn't, is AMD a great business? It's, at this price, is it a great investment? And the question you're probably asking as well, if NVIDIA is cheaper, then why not just buy NVIDIA? NVIDIA at 25 times forward earnings is genuinely interesting. It's the cleanest exposure to AI compute. Margins north of 70%. Net margin of 55%. These are software company margins on a hardware business. This has basically never happened in tech history. But NVIDIA has its own risks. Over 90% of their revenue comes from data centers. If AI slows down, NVIDIA gets harder than anyone else. AMD is a little bit more diversified. Personally, I think it's not either or, it's probably a mix of both. NVIDIA is the core AI position, AMD is the higher risk, higher growth potential on the top. But at $467, it's not screaming buy. The story is real, the business is real, the deals are real, but a lot of that story is already priced in. So I would put it into a growth bucket, not the value bucket. Something that you don't go all in on because you don't catch falling knives. You scale in slowly, you take partial profits on the way up, and you respect the fact that high multiples can cut both ways. If you don't own AMD and you want exposure, you could start with a small starter position now. If there's a pullback, that's a good chance, but don't go all in on it like I said. And if you own it from much lower levels, congratulations. Question now is to maybe trim the sizing if it's taking up too much of your portfolio and creating a risky exposure. You may want to trim some of your profits from earlier on. And if this video was useful to you, subscribe to my channel. I post at least 5 videos per week for long-term investors. Thanks for watching.